Welcome to Course 4, Foundation, Certified Supply Chain Professional, CSCP, course, by SPAO Academy. Topic 2, Global Supply Chain Networks, Section 3, Business and IT Requirements. Lesson 3, Managing Technology Investments. Introduction. Welcome to Lesson 3. In the previous lessons, we discussed why aligning business and IT is crucial and how to gather the requirements for a new system. But once you know what you need, you have to figure out how to pay for it and ensure you're making a smart choice. Technology, especially for a global supply chain, can be very expensive. This lesson will introduce you to the basic principles of managing these investments. We'll cover how to build a business case, understand the total cost of ownership, and measure the return on your investment. By the end of this lesson, you'll understand the financial language used to justify and manage technology projects. Lesson objectives. Upon completion of this lesson, you will be able to explain the purpose of a business case, define total cost of ownership, TCO, and identify its components, describe how return on investment, ROI, is used to evaluate technology projects, understand the importance of the post-implementation review. 1. The business case, justifying the investment. Before a company spends millions on a new supply chain management system, it must first build a compelling argument for why that money should be spent. This argument is formally documented in a business case. Think of a business case as a detailed proposal. It's not just about the technology, it's about the business problem the technology will solve and the value it will create. A strong business case answers the question, why should we invest our limited resources in this project instead of another? A typical business case includes executive summary, a short overview of the entire proposal. Problem statement, a clear description of the current business problem or missed opportunity, e.g., we are losing customers because our inventory data is inaccurate, leading to shipping delays. Proposed solution, a high-level description of the recommended technology and how it will solve the problem, e.g., implementing a cloud-based inventory management system with real-time tracking. Analysis of options, a brief look at other possible solutions, such as doing nothing or upgrading an existing system, and why the recommended option is best. Financial analysis. This is the core of the business case. It includes projections of costs, benefits, and financial returns, which we'll cover next. Risk assessment. An identification of potential risks, e.g., implementation delays, user resistance, and plans to mitigate them. The business case is the foundational document that gets a project approved and funded. 2. Total cost of ownership, TCO, seeing the big picture. A common mistake beginners make is only looking at the upfront purchase price of a technology. However, the cost of owning and operating a system over its entire life is often much higher. This concept is called total cost of ownership, TCO. TCO includes all costs associated with a technology investment from start to finish. It can be broken down into three main categories. Category: direct costs, upfront, description. One-time costs incurred to acquire and implement the system. Examples in a supply chain context: software licenses, new servers, hiring a consultant for implementation, initial employee training. Category: ongoing costs, operational, description. Recurring costs to keep the system running. Examples in a supply chain context: monthly cloud subscription fees, IT staff salaries to maintain the system, software updates, help desk support, energy costs to power the hardware. Category: indirect costs, hidden, description. Less obvious costs that can arise over time. Examples in a supply chain context: downtime, lost productivity when the system is offline, the time employees spend learning the system instead of doing their regular jobs, the cost of integrating the new system with other existing software. By calculating TCO, a company can compare different options realistically. A cheaper upfront software license might end up having a much higher TCO than a slightly more expensive one, due to high maintenance fees or poor support. 3. Return on investment, ROI, measuring the gain. Once you understand the total cost, the next question is, what do we get back for that spending? This is measured by return on investment, ROI. ROI is a performance measure used to evaluate the efficiency of an investment. It compares the magnitude and timing of gains from an investment directly to the magnitude and timing of costs. In simple terms, it answers, for every dollar we spend, How many dollars will we get back? The basic formula is ROI equals net benefit, total cost, by 100%. Net benefit is the total expected benefit, e.g., cost savings, increased revenue, minus the total cost, TCO. Total cost is the TCO we discussed above. Example: imagine a company invests in a new warehouse robot. Total cost, TCO, over 3 years, $150,000. Expected benefits over 3 years. Labor cost savings, $100,000. Reduction in damaged goods, $20,000. Total benefit, $120,000. Net benefit, $120,000. Benefit, minus $150,000. Cost, equals $30,000. ROI equals minus $30,000 per $150,000. X 100% equals minus 20%. In this example, the ROI is negative, suggesting this would not be a good investment. A positive ROI percentage tells stakeholders how much profit the investment is expected to generate relative to its cost. 4. The post-implementation review. Learning from the past. Getting the project approved and the system up and running isn't the end of managing the investment. A crucial, and often skipped, final step is the post-implementation review, PIR. A PIR is conducted several months after the new technology has been in use. Its purpose is to evaluate whether the project delivered what it promised in the original business case. During a PIR, the project team asks questions like, did we achieve the benefits we projected, e.g., did inventory accuracy actually improve by 20%? Did we stay within the TCO budget? How is user adoption? Are employees using the system effectively? What unexpected problems or challenges occurred? What lessons can we apply to future technology projects? The PIR is not about placing blame. It's a powerful learning tool that helps a company get better at managing technology investments over time. It closes the loop, ensuring that the time and money spent on a project lead to continuous improvement in the company's processes and future decision-making. Lesson summary: managing technology investments is a critical skill in modern supply chain management. It ensures that money is spent wisely and that new systems actually solve business problems. A business case is the formal document used to justify a project and secure funding. Total cost of ownership, TCO, provides a complete picture of costs, including upfront, ongoing, and indirect expenses. Return on investment, ROI, is a key metric that measures the financial gain relative to the cost of the investment. A post-implementation review, PIR, is a vital step to verify that the expected benefits were realized and to capture lessons for the future. By understanding these concepts, you can speak the language of business leaders and contribute to smarter technology decisions in your organization. I really appreciate you spending your time with me today. If you want to learn more, don't forget to hit that subscribe button. Your like means the world to us and helps this channel grow so we can continue bringing you great content. Thanks again, and see you on the next video.